Welcome back, investors, to Ticker Time News. I'm Adam, and our top momentum stock for this week set another 52-week high today. This stock has been our number one momentum stock for 4 out of the last 5 weeks, and it is up over 30% during that time frame. And for that 1 week where we didn't pick it as our top spot, it was still our number 2 pick of that week. Now, you can get instant access to our weekly momentum stocks by clicking the first link in the description. And let me just tell you, it's on the chart here. Exxon Mobil, ticker symbol XOM. Yep, it is our top momentum pick for this week. Can it continue this momentum? We shall see. It is on our list for this week. It is in the number 1 spot. It is up over 30% in the past 5 weeks alone. Will this chill out? We'll see at Friday. We'll bring this back up on Friday. But again, if you want instant access to the other 9 in our top 10, just click the first link in the description. Now on to a favorite of mine, at least it used to be more so than it is now. PLTR is the ticker symbol for Palantir. Now, Palantir, their earnings came out. They fell 12% today, following a Q3 earnings miss and a downbeat Q4 revenue guidance. Now, for those that are showing up for the live stream who are here about today's action in the broader market, I will be talking about that as soon as we discuss Palantir and their earnings report for just a couple of minutes here. Now, being a relatively pricey cloud stock, Palantir is trading about 8 times forward sales. Plus, shares of Palantir, they already slid over 8% last week from the Fed November 2 meeting, where the Fed raised interest rates by another 75 basis points and did not signal a pivot from its current hawkish stance. However, even though the Fed's rate-raising campaign has weighed on Palantir this year, it has suffered its own share of company-specific issues, further evidenced by a fewer, less than stellar Q3 numbers. I guess I could put it that way. Now, before we dive into Palantir's earnings report, know that you can beat this crazy market with us by clicking the first link in the description. I'd love to see you there. Now, when Palantir went public just over 2 years ago, investors focused on meaningfully improving commercial growth. Therefore, playing a major role in today's price action is, drumroll please, commercial revenues, and they were slowing down dramatically in Q3, going from growth of 46% year over year in Q2 to just 17% in Q3. Even worse, Palantir's core U.S. market commercial revenues decelerated to just 53% year over year from the amazing 120% in Q2. Now that's a drastic cut. A drastic cut. Yep, got that one right. If not, it's okay. It went over my head partly too. Now, Palantir cited the ongoing macroeconomic slowdown as a reason commercial revenues barely budged in Q3 relative to Q2. Now, we have to find the good in everything, right? So the silver lining here is that net new U.S. commercial customers grew at 124% year over year and 11% quarterly, marking Palantir's 7th straight quarter in a row of quarter-over-quarter growth of over 10%. There was one factor outside of Palantir's control that also took a bite out of its commercial growth in Q3. A strong U.S. dollar. And we're going to talk about the U.S. dollar when we get to the broader market because it's at an inflection point, a big one, like one that it's faced 5 times so far this year, and each time the dollar has won and the stock market has lost. So the dollar's on a 5-win streak here. Is it going to be 6? Is tomorrow going to be the 6th time the U.S. dollar beats the stock market and the U.S. dollar is going to rise, the market's going to fall? We'll talk about that in just a moment. It's coming up, I promise. Now, Palantir's Q4 guidance was not very appealing either, expecting revenues of 103 to 100. I'm sorry, revenues of $503 to $505 million, or 16.4% at the midpoint of those two numbers, representing another quarter of slowing growth. Not good, not good at all. Now, the FX headwinds did play a role. I'll give them that. Estimated to dent revenues by about $5 million to be exact. However, despite excluding that $5 million impact, Palantir's Q4 guidance does not shine very brightly, as it still shows sales growth under 30%. Now, why does that 30% number matter? Why does it matter that they will not be growing over 30%? This was Palantir's 3-year annual sales target just 2 quarters ago, highlighting how rapidly its own expectations have shifted. Also, unlike last quarter, when CEO Alex Karp still noted that he believed Palantir would reach its fiscal year 25 goal of $4.5 billion in sales, nothing, nada, zilch, was said during its Q3 earnings call. Overall, the environment is not fitting for Palantir, and it's still relatively pricey multiple, evidenced by another quarter of uninspiring results. Also, Palantir's valuation is becoming more attractive as shares have plummeted by over 60% year to date and are now trading around its direct listing price of $7.25. You can see it closed at $7.02. It is up about a 10th or 2% in the after hours, but that's a wild 2-year ride if you bought their direct shares and you have held them this entire time. Now, the company is also sitting on a pile of cash that I cannot discount. That is big. It's $2.4 billion. And the company has no debt. So that's 2 things going for the company right now. Still, I don't really think that it's best to view Palantir, or let me rephrase that. I think it is best to view Palantir from the sidelines, as a slowdown in the global economy is now coinciding with a still hawkish Federal Reserve, which may continue to be a heavy weight, one that's just too heavy for Palantir to bear over the near term. Well, that's what caught my eye during Palantir's quarter. What do you think? What did you see during Palantir's Q3 earnings report? Let me know in the comments below. I am eager to hear from you. Okay, let's get on to today's broader market. All right, we'll pull it up. I'm going to SPX first. All right, for the S&P 500. Now, today's price action, well, it was extremely contained, and it was shaped up mostly. It shaped up mostly to be a positive day. I have to give it to it. The SPX, or the S&P 500, and the SPY, both up 0.96%. The Qs had a positive day, up 1.1%. The IWM up 0.5%. The MDY up 0.9%. The Dow stole the show, up 1.32%. Mega caps, well, let me rephrase that. Mega cap companies in the Dow Jones are winning right now. People are finding safety in those companies, those 30 companies. Those 30 companies, for the most part, have held up well to earnings. Why? Mainly because of energy. Energy is a big component in the Dow, right? You've got the Dow transportation. Now, the actual transports, they're not the ones doing so hot, but the oil companies are, and that's helping. Now, the major indices did experience choppy action most of the session, pressured by rising treasury yields. What else, right? And price action in Apple. Now, before I dive into the charts here for the broader market, let's talk about Apple for just a moment. AAPL is the ticker for Apple. Apple was up 0.4%. Now, when you look here, Apple, man, it was in a deep hole. It had fallen from earnings, and all the pressure and talk last week about a potential slowdown. Let me put that vertical line there to represent earnings, a big day after earnings. But since then, it's just been collapsing. It did have a pretty decent day today. Let me just adjust this chart here a little bit so we can see this price action here. Okay. All right. Now, this is the updated weekly expected move for Apple for this week. So the top end of that is at 145. The bottom end, or the lower end of the weekly expected move, is at 131. Now, the stock market shifted into rally mode in the afternoon. So did Apple, bringing the S&P 500 above the 3,800 level. Oh, and that just reminded me. We need to talk about a couple things real quick before I talk about Apple. My apology for getting this mixed up here. Now, the shift in the momentum coincided with the US dollar index, ticker symbol DXY, which had been on a steady decline, but it took another leg lower. Let the dollar load here, ticker symbol again, DXY, because we got to talk about the inflection point for the US dollar and for the S&P 500, okay? The US dollar index fell 1.8% on Friday, and it was down another 0.7% today. But this puts the US dollar and the S&P 500 at key inflection points, and only one of them is going to win. Either the US dollar will bounce from the solid support, or it will finally be taken down, and it will break down for the first time this year. The last 5 times the US dollar has been in this position, it has bounced. That's how important this level is. This level is. Look at this. Let me bring this chart in. I got to click a quick button here. Okay, there we go. All right, let's bring this up. Okay, so if we're looking here, let me get the highlighter here too. All right, we're looking at the 2 black lines. They start down here at the beginning of this year. All right, and this is our trading channel all this year. If we count, all right, from February, this will be about February 23rd, we get our first tap on this line on the lower side. And then we have another one here, okay? And then we have another one here. And then we have another one here that almost breaks down. This is the first time all year, and this is back in August, that the dollar broke down intraday before finally bouncing back up, okay? And then we have here, which isn't that long ago, we're looking at October 27th, right? And then today, we are right there. We are sitting on that same line. So if we go back 1, 2, 3, 4, 5, the last 5 times the dollar has been in this position, it has bounced, okay? This is a very significant level. If you take only one thing away, take away this. Go to the DXY, put your trading channel on there, okay, for 2022. It really gets into this channel. February is when it finally finds that low point that it continues to bounce off of, and that's the point I have marked out here. Are we going to be 6 for 6 with the dollar bouncing on this line tomorrow, or is the dollar going to break down tomorrow for the first time in 2022? What do you think? I'm still leaning on the side. The dollar is bullish until it's proven otherwise. The dollar is bullish until it's proven otherwise. You cannot discount something that has bounced off of this significant level 5 times in a row, and then all of a sudden the 6th time rolls around and you think, oh, well, yeah, I guess this doesn't mean anything. It could just go right through this. No, you have to pay very close attention when you see a pattern like this. All right. So let's bring this in a little bit closer and see if we can't just dissect a little bit of what's happening right around here on the chart. Oh, I see your comment there. Let me throw that up on the screen so we can all see that. I don't know where to find relative strength and weakness anymore. To be completely honest, it is very difficult. I don't know how to put it into perspective. I don't know what the best, let me rephrase that. I don't know what the best way is to put this into perspective. Right now, in this part of history, okay, this is the most difficult time to trade. It's the most difficult time to trade because not very many things make sense. That's why you can't force trades. You have to wait for the setup to happen, all right? With what we're doing here with the dollar, this is a setup that could very, very easily take shape, right? We're looking at the dollar. And if you want to go bullish on the dollar because you think it's going to bounce here, then the ticker symbol you want to use is UUP, okay? UUP. That's bullish on the dollar. And at this level, since the dollar has found support on this trend line 5 out of the last 5 times, then you can't discount it right here. It could very, very easily bounce. And if I remove the blue line, the highlighter right here for today, okay, it's tough to see, but the wick did break below this trend line, and it came down to this blue trend line that's going horizontal here. Let me highlight it, okay? This trend line, it connects right here, okay? It even goes back and connects right here, and it goes back and connects right here. So at first it was resistance, resistance, resistance. There's another spot right there where it tagged it. Then this line turned into support, which was where these 2 big candles right here, where it bounced and came back up. And then it broke through right here on Wednesday, October 26th, to this trend line, and it bounced off that trend line. Real nice bounce off the trend line. We had that nice rally leading into the FOMC meeting. And then from FOMC meeting, where we were at key resistance, the dollar broke down, okay? Now the wick did bounce off of this blue trend line right here. So something that used to be resistance, now support, except one time where it did break through that, and that's okay. Understand those. They're okay. It happens sometimes. And we got the bounce. See, with the S&P 500, I went long on Friday. I'm still long. When we get to key levels, that's when you have to assess your position. I'll show you on the I'll show you on the SPY how I do that, okay? And that may help to answer your question here a little bit. And it's stuff that I've talked about many times before, but I'll try to put it into a very precise bit of commentary. All right, let me clean this dollar up right here. So you can see the significance of the dollar being at this particular point in time. Okay. Let's go to the SPX real quick. Now we're going to look at the opposite. Okay. A place that sometimes it's support, sometimes it's resistance, but it's a very particular level on the S&P 500. Okay. Because the S&P 500, SPX, or even the SPY using different numbers though, it's at its own key level. And it will either get rejected between the 3800 and 3810 zone, or it'll break through. And if the S&P 500 can break through this level where it's at right now, then we could see a nice relief rally. But for the S&P 500 to break through, that means the dollar is going to break down. So whose side are we on? Are we on the side of the dollar, who has shown the last 5 out of 5 times it's bounced from that level? Or are we on the side of the S&P 500, the equities, currency or equities? It's a tough one. The dollar, I just showed you, there's some pretty good support where it's at on multiple levels. Now for the S&P 500, it's a little bit different, okay? Let me open this up a little bit. So here we are. We're on this blue trend line. That's where we stopped today, okay? At 3806. 3800 to 3810. Think of it as a zone. This zone has seen a lot of reactions off of it, okay? One other thing to note is that the 50-day moving average is at 38. I'm sorry, where's the 50-day here? The 50-day moving average is at 37.99. So just take it up 1 point and say the 50-day moving average is at the 3800 level. That's how significant this level is. And remember what I used to say back in the bull markets about the 50-day moving average? Bearish below, bullish above, or bullish above, bearish below the 50-day moving average. Well, the 3800 level, recently at least that is, that's how it's been. It's bullish above 3800, bearish below 3800. And on the SPY, that would be 380. Okay? The SPY is at the exact same point the SPX is. All right. So the past few times, let's go right here on the blue line. Support, support. All right. Resistance and resistance, resistance, resistance. This is a significant level. So if the S&P 500 breaks above this 3800 to 3810 zone, that will be bullish, at least for a little while. Then we have this level right here, okay? This level is 3900, only 90 to 100 points above the zone that we're at right now. And you can see the last time we were here, resistance. Prior to that, the last time we were here, resistance. But it was support and support before then. Old support becomes new resistance. Old resistance becomes new support. It happens all the time. All right, so let me clean these levels up. When you're trading, okay, it's important to understand the bigger trends, okay? Using the daily time frame, that's where you can find these trends, these zones, these numbers to pay very close attention to. But when the VIX is so high, it's hard. When there's so much flimsiness in the market, it is hard. And for a new investor, it's important to recognize this isn't typical, okay? the price action we're seeing from market participants is not typical, right? We're either in a bull run and we have very defined zones where we go, we get rejected, we bounce, and we move higher. And it's very easy to follow. A bear market is the opposite of that. It is complicated. It's messy. It's hard to understand. And especially when you're getting into the potential area here of potentially forming a bottom for 2022, right? It's possible that that's what we're doing. We're going through this transition because we have already hit the bottom for 2022. If I go and look at this at a broader perspective, okay, let's look at this. All of 2022 right there. Bearish, bearish, bearish. But we have been able, right? We had a lot of movement around this area right here, which we're above right now, okay? And if we go back in time, that used to be another area of chopping around. It just didn't last as long. But now this chop is lasting longer, meaning we could be in the transition period of forming a bottom for 2022. Okay? Look at all the other times this year. All right, this time I just highlighted. We go back further. Look, we're down for a day. We're down for another day right there, right? We use this as support and bounce off of. Look at this. Support here just one day, and then here down there just one day. We find support right there. We fell hard, and then we bounced. We fell hard, we bounced. We fell hard, we bounced. We fell hard, we bounced. And let me just highlight that real quick. Fell hard, right? Bounced. Fell hard, bounced. Oh, the highlighter is a little behind me, right? And then bounced. Oh, come on, highlighter. Bounced. Fell hard, bounced. Fell hard, bounce. Huh? Well, if you look at the V's that were just made, they were kind of uniform coming down. Small, medium, large, and now we get a checkpoint. A check here, a reverse check mark. What are we making here with these? I don't know. But the choppiness right now could be because we are transitioning. All right. And transition zones are always hard. Transition zones are where the market will wear you out or the market will stop you out. I don't know how that phrase goes exactly. But let me go back and demonstrate the flip side of this. Look, when we were topping, right? And I want to look in this specific area right here. Okay? When we were topping back November, December, the very 1st of January of 2022, the end of 21, beginning of 22, it was really hard to find your way for these 3 months, November, December, and January, before we transitioned from the bull market to the bear market. Okay? Now, right now, we could be in that same transition period, and that's what is making things extra hard. Okay? All right, let me just clean this chart up here right quick. All right, let's go. All right, and let's do this, and then open this back up. Now, the stock market, it did show. Oh, Okay, so just understand this for tomorrow. I've showed many times that the dollar and the S&P 500, they have an inverse correlation, okay? Inverse correlation. That means that when the dollar goes down, the S&P 500 goes up. With the dollar at that support level, and with the S&P 500 or SPX at this point, this support, sometimes resistance, other times. And remember, let me get my highlighter here. When we were in this rally from mid-October up to the beginning of November, this 2800 to 2810 was support. It could be flipping now to resistance. So we do have to be careful about that. Okay? All right. I did say that on Friday I entered a long position, and then I'm currently still in that long position on the S&P 500. I did lighten it a little bit because we are at that inflection point. I did tighten up my stop loss, and actually let's go into the 15-minute chart here. I did tighten up that stop loss today. So if it does start to drop because the dollar is going to bounce, I'll get stopped out real quick and be able to keep some of the profits from the past session and a half. Okay. Let's open this up here. All right, 15-minute time frame. This is the past 3 sessions on the chart here. So since mid-afternoon on Friday, we rallied. This morning, we were flat, right? We were flat. And then we started to rally in the late afternoon before selling off. Why did we sell off in the afternoon? Because we got to that 3,800 zone, 3,800 or 3,810 zone, and then the dollar reached its support level. So market participants did not want to be in equities at this moment in time. Remember the phrase I say often, don't short in the hole. When the market is down, that's not where you want to short, okay? The market is starting to come out of that hole right now, okay? But a choppy session, which, look, we dropped hard 4 sessions ago, okay? But if we go back to that point, all right, let's just look at the past 3 days, all right? We've got this kind of support area there, and then we go to the 3,800 area, and basically for the past 3 days, we've just chopped around in that box, okay? The chop is hard. The chop is difficult. You feel like you can be losing out. All right, let's open this up a little bit more. I want to get a few other days in here. Again, this is the 15-minute time frame. I'm going to get a good amount of data in here just so we can see kind of these shorter trends here. Shorter time frame trends. All right, so it's going to be a pain and take a while to load. Okay, so if we go back here, I'm going to go right in the middle of the chart. We found support, and then it moves. My life with the chart. My life with this chart in this live stream. Doesn't always work out very well. Okay, come on, highlighter. That's what I want. Okay. Now, the stock market today, it did show resilience to selling pressure, but we got to a point where, look at this. This is what I pointed out just a little bit ago. This is the chop box that we've been in for the past 3 sessions, all right? 1, 2, 3 sessions. And then before that, what did we do? We chopped around in this section right here. And that was for 1, 2, 3, 4, 5, 6, 7, 8 sessions in a row. All we did was move sideways. We went nowhere for 8 sessions. So my point here with these bigger view on this 15-minute time frame here is you don't have to make a trade every day. Be patient, wait for a trade setup to come, okay? And just using the past 2 weeks, okay, we got this big drop right here. This is where you'd want to look for a place to go long. After the big fall, okay, in this zone right here, this is where you'd want to look for potentially a long setup for the SPY or S&P 500. It was a big move down. The last time we were down here, okay, we found support, we found support, we found support. The last time we were down in this area. So this is where you'd want to start opening up a few longs. Definitely not going short once we've already fallen, okay? We could, if the dollar holds support and we fall tomorrow, right? We could just end up going back 3 sessions ago to where we were, and basically over Thursday, Friday, Monday, maybe even call it Tuesday of trading, we're back where we started and we have literally gone nowhere. The chopping around, okay, it makes you feel like you're moving because the market's going up, the market's going down. But that chop is what makes you feel like if you're not trading, you're missing out because things are moving. But they're going nowhere. So you don't have to force it, okay? Oh, yeah, here we go. I should have read your comment. Yeah, I'm not trading this week. IDK, what to expect with midterms. On Friday, the live stream, it was a little bit different of a live stream. But during that live stream, I talked about this week and how the 3,800 level would be very important. I talked about how Tuesday with midterm elections, that could be difficult. And I talked about Thursday. Thursday, we've got CPI. It could be difficult. It could be a difficult week, but Tuesday and Thursday, they're the big days. They're the big days that are going to show us which way this market is going to move. And then once the market starts to move, then get in. Don't FOMO in if we end up breaking this 3,800 level or 380 on the SPY. When we get up to the 3,900 level on SPX or 390 on the SPY, don't go rushing in to buy more. At that point, take some profits off the table because that's another inflection point. And recently, it's been a resistance point. So if we break the 3,800 area and we ride up to 3,900, don't add when you get to 3,900. Take some off the table. Take some of those profits off the table if that's the course we're going in. But if CPI comes in hot on Thursday, that could send the markets back down. So there's a lot riding on this week. Now, I think once we get past the midterm elections on Tuesday, the market will be able to take a breath and calm down a bit. Why? Well, right now it seems to be forecast that what happens in Congress on the national level, things are going to change. What does that mean? Well, that means there's going to be gridlock in Washington. What does gridlock mean for the stock market? Gridlock means there will be no more bills passed for tax hikes. There'll be no more bills passed on massive spending. What's that going to do to the market? That's going to provide some certainty and some calm to the market. Okay? Because neither side's going to get their way, meaning the market can be more stable. So getting past Tuesday is step 1 this week. Step 2 is Thursday. Keep that in mind. All right. I spent a lot of time talking here. I hope that's okay. At this point. All right, let's keep rolling with my notes here, and we'll get through the indices here. But the SPY and the SPX, they are both at very important points that line up with the dollar. Just keep that in mind. One of them will break down. One of them will be able to continue higher. Which one? I don't know right now. I'd probably put a little bit more on the dollar because it's at a point that has held, but past results are no guarantee for future performance. So don't think for 1 second that it has to hold as support for the dollar. But you can't discount it. I know I'm kind of like saying 2 different things at the same time, but I hope you get what I'm saying. Okay. All right. So let's keep moving on. Okay. Other supporting factors today that caused the market to kind of bounce and continue late into the close, except right at the close. We had speculation in the market that China could relax its zero COVID policy. That would mean more oil, more gas, more energy going to China. That would cause energy prices to accelerate, to go up, to appreciate. That would mean it would be harder for Europe to get energy because China's buying it from Russia, refining it, selling it to Europe. We also have, like I mentioned just a moment ago, we have the expectation of the midterm election results. And again, it looks like it's going to change, okay? And we're going to have gridlock. And that means nothing's going to happen. Now, what I wanted to mention about Apple, Apple was able to get a gain today, all right? A slim one, but it was able to. But it weighed down index level performance today. This came as even last week, but last night, I believe I tweeted about it last night. Apple said that it's going to cut its iPhone 14 Pro and iPhone 14 Max production expectations. And that means they're not going to make as many, right? So the reaction, it wasn't a big overreaction for Apple. But it did provide at least some selling pressure. And of course, Apple is a big company and it affects the broader market. Now, last week, we kind of had a sense of this. Apple declined nearly 11% from its highs on last Tuesday to last Friday that week. Okay. All right. Moving off of Apple. The only economic data that we got today was the consumer credit report for September, which showed an increase of $25 billion and that was followed by a upwardly revised 30. Oh, I'm sorry. I meant to take this off when we went to the other topic here. And then last month was revised up from 23.8 to $30.1 billion in August. So the key takeaway here is that the consumer credit growth, it persisted, kind of like inflation, demonstrating that the demand for credit has not vanished in this rising interest rate environment. That point notwithstanding, a slowdown in the pace of expansion is expected as home lending activity and auto lending activity weaken in the face of higher prices and higher interest rates. Now, tomorrow morning, we do have a whole bunch of earnings, and let me share this with you. The most anticipated earnings from Earnings Whisperer. They do a fabulous job here at this every week. All the way to the left, we've got Mondays, which is now past. Then next, we have Tuesday. We have the major ones before the open and the major ones after the close tomorrow. Disney is a big one when the market closes tomorrow. We've got Occidental on here, AMC, Upstart, Plug Power, Lucid, all Affirm, all those big names that retail investors like. After the market closes tomorrow, before the market opens, we got Norwegian, Party City, Builders First Source, SunPower, and they've been hit or miss. DuPont, so a whole bunch coming up tomorrow, and then we see Wednesday, Thursday, and then Friday. Before they open, there's nothing of note Friday after the close. So that's this week coming up as far as earnings. So there's some good ones on there for sure. Matterport is going to be an interesting one. I want to see if they've done any better. Okay, I've talked a lot about the SPX. Let's go over the SPY, the Qs, the IWM. And also I'll pull up the DIA for the Dow. Now, the SPY, it is in the same boat here as the SPX. I'm going to overlay the SPY with the DXY, or the dollar, the US dollar. All right. Okay. All right, let's load. All right, there we go. So you can see this year, the orange squiggly line at the top of the screen, that's the dollar. The dollar has been rising as the SPY has been falling all year. And you can see here at the very tip, you've got the dollar coming down and the SPY has been going up. Both of them are at this point that one is going to break. Is the dollar going to continue its bullish run of 2022? Which then that would force the SPY to go and have a cool-off day tomorrow? That's a possibility. Okay? That's a real big possibility. All right, let me clean this up. So that's for the SPY and for the SPX. That's the number one thing that I'm watching for tomorrow, how the dollar reacts. Because that's going to tell us a lot about how the SPY and the SPX should act. All right, let's take the dollar off. Okay. Dollar is off. All right, let's go to the Qs, because really everything I said about the SPX is true for the SPY. It's just 380 is that key level. It's at it right now. If it can break 380, you know, then it'll probably run up to 390, and then we'll have resistance there. Okay, let the Qs load up here. It's taken a little bit, but we're getting there. All right, let me open this up a little bit more. Let me adjust this chart. Give me just a moment. If you have any questions too, I know it's tricky, so it's okay if you don't. All right, so for the Qs here, you can see completely different setup. It's nowhere near its 50-day moving average. It is at a very particular point here, though, and I do want to point this out. Let's get a highlighter here real quick. All right, if we go back to the beginning of October, we had this point right here, okay? It acted as an inflection point where price pivoted, all right? So we can call that a pivot point. Then when it was coming back down, we found a little bit of support there, at least for a day, before falling, okay? We are at that same pivot point right now that we were at the beginning of October and about the October 9th, okay? So October 1st and October 9th. We're at that same point right now. This could be a pivot lower. Now, if we look in the middle of the two and we go to October 21st and a few days before that, this particular point became support again. So support, support, support. What's it going to do now? Are we going to get resistance at this level? Or can it break above it? It's a good thing to watch, okay? So I know today's live stream and the topic for the main indices, it's not fun because everything is at these pivot points, okay? And when we have these pivot points showing up like this, it can make the trade more difficult. But these are places that if we do get a certain action, that can be followed by a certain action. For example, if the Qs do break this level, then you could be looking at a long position here for the Qs. If the Qs get rejected here, you could look for a short position to open up, but don't force it. Wait for the setup to come. All right. The DIA, which is the Dow Jones, the ticker to trade the Dow, it is holding up the best out of all of them. It really is. It found resistance at its 200-day moving average on Friday, but today it just broke that trend and it is going higher. Now, we have got to watch this high set on last week. We got to watch last week's high. We got to break that. We break last week's high and we can be going higher for the Dow. And that could be good for the other indices as well. Now, for the Dow, or ticker symbol DIA, 332 is the weekly expected move up top, and 315 is the lower end of that weekly expected move. Let's see here. Let me put your question up here. Do you think Apple will ever drop on earnings? They have yet to guide down. I don't know how they would beat on earnings when money was everywhere last year, and now everything is slowing down. Okay. The easiest way to talk about this is there is, and I know I talked about it last quarter for Q3, saying that we will have an earnings recession. Well, Q3 was not too bad, especially because of energy. You take energy out and the quarter is down a bit. So we will have an earnings recession. That is absolutely coming. And that's coming for Apple too. That's why a lot of the FANG stocks fell so hard last week. And they may catch a bid this week. It's possible. They're oversold. They may catch a bid. And that's fine. The market moves in cycles. But earnings recession is coming. Q1 is probably not going, well, Q4 reported in Q1 probably isn't going to be that pretty. I can imagine this holiday season being slower than last. And then when Q4 is reported, that could bring the market down even further. So that's why I've been talking about these bigger ideas about what if, looking at the SPY, looking at the Qs, what if we're in a transition period right now where we have hit the low for 2022 or for the current quarter, right? So we can rally a bit into the close of the year. But then once we get into 2023, with the earnings recession surely coming within an earnings or two, a quarter or two, I should say, that is just going to drive the market down harder. So then that's where we could undercut the 2022 low. So I do think it's coming for Apple. There's no doubt about it. And it's coming for other companies too. We as far as the recession goes, we have not had it bad yet. All right. Yes, we've had a paper recession. Yes, we're in a bear market. Those things are true. But we have not seen the worst of it yet. And the worst of it will come next year. Okay? So don't think Apple is going to be able to stay where it's at. As a matter of fact, let me put Apple on the screen here one more time. Since you had the question about Apple, and then I'll put up IWM, and then we can wrap today up. Okay, so I'm going to go to a different view here for Apple. I'm going to go to a weekly view and get a grander sense here of where Apple is at. Just take a minute for the chart to update here. All right, there we go. Now I got to smooth this out a bit. Yeah, every time Apple dips, it surely does. All right, look at this. This is just incredible. If you look at Apple, I mean, this is how well the company has been holding up. Let me get the highlighter on here. Actually, I need to adjust this right quick. All right, so we've got our March 2020 low right there, about $54 a share. Again, this is a weekly time frame. We get our 2020 rally to September, and then we stall. And then from September all the way to June of the following year, okay, we chopped around. Took a leg higher, and then really you could go and box off the high right there, and box off right here, and Apple has really gone nowhere since August, September of 2021. It's been traded in this chop box, up and down, going nowhere. So Apple has not been affected as nearly bad as others. I mean, think about what the S&P 500 looks like for 2022. And you look at Apple basically going sideways. There's no comparison. No comparison. So Apple has not seen the worst of it yet. You've got Google, like all the way down here relative to where Apple is at this moment, trading at the 2019 high and the February of 2020 high right before the pandemic. So once Apple hits its earnings recession, who's not to say that it's going to come down in this direction too? Just like Google, okay? Just like other FANG company that's lost out big. So Apple has held up really, really well during this bear market, but that cannot last forever. Earnings recession is coming. I do not believe 2023 is going to be very good for Apple. I think it is going to finally face the music in 2023. But for now, it's holding up real nice. Holding up real nice. All right, let's go to the IWM. Small caps have been doing fairly well, but still, on the weekly time frame here, haven't changed it yet. And you can see the bigger trends here. November of 2021 was the high. And if we go and put a trend line right there, and then you want to clone it and bring it down to the bottom. Man, it's tough. Where do we line it up here? This has just been brutal. We could probably go right there. That looks to be catching the majority. There's that one little time where it broke out of this trading channel. So looking at this trading channel right here, going from November on the weekly time frame, November of 21 to present, it still has a little ways that it could travel upwards. Looking at the what would this be? Probably the 185. And that would be a area on that trend line, which quite frankly, let's see, just moving forward in time, kind of matches up with the weekly expected move. And the weekly expected move for the IWM is 185. That's very interesting. The 200-day moving average is just under that trend line coming down. It's about 186. So that'll be an interesting area for small caps there. All right. Well, that's everything on my notes for today. If you have a question, now's a great time to plug it in. I'll give you a couple minutes in case you do have a question, give you time to put it in the comments. But if you could, do me a favor, click that like button, share this video with a friend, And if you like the perspective and you want instant access to our weekly momentum stocks, our weekly expected moves, our trade setups and ideas, and market and economic insights, and a whole ton of things, click the first link in the description. Join us. All right. Okay, so I guess we're all good then. All right, so I do have my stop loss ready to stop me out tomorrow if things do take a turn. And I did lighten up the long position from Friday, but it is still open. I'm waiting. Yes, housing has come down. In my area, Northern Virginia, it's typically in a bubble and doesn't really fluctuate a whole lot compared to the rest of the country due to all the government employees in this area. But yes, housing has started to come down, but just ever so slightly. A couple of the charts that I've been looking at when looking at the housing market, because this housing market comes down, I'm a buyer. So I'm watching it very carefully. I want to see it come down. But interest rates are another thing, okay? The higher interest rates go, the more housing is going to fall. So just keep that in mind. When the Fed stops raising its rates, when the Fed stops raising those interest rates, then we need to pay very close attention to what the banks do after that. Okay, are the banks going to take that as a sign that say, okay, the Fed may be slowing down or may be done? Interest rates are a big factor in the housing market. And what did I see? For every 1% that interest rates go up, the housing market does come down by 10%. Don't quote me on that, but I think that's what the ratio is. We also have rentals that are a big deal. Rentals may come down in this CPI report on this week. It could play into it pretty darn big. Let's see here. Housing does have a weight on CPI. Yes, it does. And I believe, can I get to it here? I don't know if I can get to it in TradingView or not, but it's on the Fred website. Let's see. I thought there was, I guess TradingView doesn't have it. Let's see, what is this one? Housing affordability index, and it's just gone down. Yeah, that's crazy. No surprise there. Is it possible to bring inflation just with interest rates? Yeah. At least that's the main tool The Fed, just think of it like this. The Fed has two things that it can do for interest rates. But I mean, for inflation. I'm trying to do two things here at once. I need to stop and just focus on one thing. The Fed can do two things when it comes to the inflation rate. Number one is to raise interest rates. Raising interest rates simply causes the cost to borrow money go higher. The second thing the Fed can do is quantitative tightening, where they're selling off what they have on the books, right? They're taking money out of the market. These two things together cause demand to go down. Because when you think about inflation, it's really a supply and demand problem. There's too much supply, not enough demand, and prices fall, right? When there's too many things on the market to buy, everybody's discounting them, putting them on sale to get rid of them. But when supply is low, but demand is high, everybody wants that new iPhone, then the price of that iPhone goes higher. But now the demand for those iPhones are going down, the price of those iPhones will have to follow, or they will just not make as many. So the company will then not earn as much. Okay. So the Fed has no control over what people want to make, right? But the Fed can make access to money, borrowing money, more prohibitive, therefore stop people from wanting to buy those things. So, yes, the Fed can bring interest rates down. I'm sorry, bring inflation down with just interest rates, because they're making it harder and more expensive to get at capital, to get at money. Okay. That means if, let's say, for example, you make a widget and you have a huge supply of widgets at first, right? You make a whole bunch of them, and then people start buying them. The word spreads. Now they're on fire. Demand shoots up. Well, now you go and open a second factory to make twice as many widgets to meet demand. Then all of a sudden demand drops off. Nobody wants your widgets. You've got two factories going. You've got a whole bunch of supply. Just constantly move those levers of supply and demand around, and you'll end up with your inflation rate going up and down and up and down. So the only thing the Fed can control is making the cost of money more expensive. Therefore, companies won't expand building that second factory, and consumers won't borrow to buy that new car you're making at that second factory. Okay. Any other questions? Throw them in the comments there now, and we'll get them answered. Now I totally forgot what I was gonna search for. Oh yeah. All right. So the Federal Reserve has tons and tons and tons of information. And I just love everything that they have. It is just incredible. I was looking for here we go. This may demonstrate. All right, let's pull this over. Okay, so that's good. Good. You know, one of the mottos or goals or mandates, something that I live by, is to learn something new every day. And you can always learn if you want. Okay, so what we're looking at here on St. Louis Fed website, Fred, which gives you a ton of economic data on anything. This is the median sales price for new houses sold in the United States. And you can just see prices. This goes back to, when is this? 1963? January of 1963. And look at how home prices have just gone bonkers from, let's just call it April of 2020. April of 2020, I mean, it's like a straight line up. Now, if we go in it and look here, we have, let's see, we have a spike in July to 479,800. August, it drops a little. It goes from 479 to 435. September goes back up to 470. And that's where it sits as of the last report for September. Be curious to see where October is. I have a feeling it's going to be down from that August high. Or I guess I should say August low. 435 for August. So it peaked in July of 2022 at 479. And September was 470. So close, but not quite there. So I'm curious about October. And it's tough to see on this chart, but we are starting to get some months where it comes down. Like, for example, March was at 435. June was 432. And then you had August at 435. So we're getting some months there where that 430 to 435 is kind of like that base number that we're starting to get. So it'd be interesting if October comes back down to that 435, maybe 440 area. That would be very interesting indeed, because you probably start to see it then roll over, right? We're probably going through a topping pattern right now where who knows how bad it's actually going to get. But if you look at December of 2017, we were at a high, and then you go all the way then to let's call it September of 2019. So a couple years there where we were declining in price, and then we hit COVID, of course. Before that, it would be homes decline going into the recession in 2007, 2008, and then right about the same time the recession ends, because that's what these gray bars are on the chart. Those are recessions. So right as the recession ended, the housing market kind of hit its bottom, maybe like a month later, before it started really recovering. And it really didn't recover until December of 2011. That's when it hit its kind of final low before accelerating and taking off to a peak in December of 2017. So we're still at the top, but I think we're doing a topping pattern there. So watching this will help to answer your question, how housing prices, if they're coming down or not, right? All right. Well, I'm glad everyone is good. We'll go ahead and wrap this up then for today. Again, tomorrow, just be careful. We're at inflection points for the dollar. It is at a low, and it could come off of that. And if it does, that's bad news for the markets. And if we look at, I know from closing bell to right now, I know it doesn't say much, but we are getting a green candle thus far for the Dixie for tomorrow, okay? And if you want to bet on the dollar and its 2022 strength, it's probably not a bad bet, but it is a risky one. Because, you know, the sixth time, that could be the time that it breaks down. You just never know. But it is at a critical point. So if the dollar does not bounce here, that means equities should. Okay? If the dollar breaks down, equities should go up. But we're at a very, very important point right now. And it's probably best, the safe thing to do, the less risky thing to do would be to not trade it at all. Okay? Not trade it at all. All right, let me just look, make sure I got all my notes. Yep, that's it. Okay. Well, if you guys are good, I'm good. Thank you so very much for joining me this evening. Make sure to click the like button, share this video with a friend, and if you like the perspective, click the first link in the description. You can get more, plenty of it. All right, thank you very much. I'll see you tomorrow after the market is closed to talk about what happened, why it happened, and what to expect moving forward. So thank you for your time. I greatly appreciate each and every one of you. Have a good night. I'll see you in the next video. Take care.